Welcome to the latest edition of our virtual investor series. I'm Susanne Matern, Head of European Structured Finance, and today I'm joined by Kay Ishidoya, Senior Director in our EMEA Structured Credit team. We are going to discuss the 2023 mid-year outlook for European leveraged loans and CLOs. Welcome, Kay.
Hi, Susanne.
When we discussed last year, we discussed the impact of rising rates, inflation, lower demand, and the Ukraine war, and these factors all still are there. So what does it mean for the outlook for European CLOs?
Let's think about the underlying assets for these transactions, the leveraged loans. They've been going through quite a bit of turbulence recently with the rising interest rates and inflation. We expect the performance of these assets to continue to deteriorate. However, we do think that the CLO notes will be able to withstand additional defaults. Broadly speaking, we believe that the ratings for our notes will be stable with some pockets of risk in our portfolio. Because the leveraged loans and the CLO transactions have different dynamics underpinning them, let's first think about the leveraged loans, right? There are three big things driving pressure onto these corporate borrowers. Number one is interest rates. Actually, I really want to talk about this because to me, the numbers are quite striking, right? We know that Euribor has gone up very quickly over the last year from negative to 3.5%. And the last I looked, these underlying borrowers are issuing loans at 6% margins, right? That's like 4.5% last year up to 6% now. You add 6% to 3.5%, that's nearly 10%. And so these borrowers are paying nearly double the rates today that they were paying a year ago. Number two is inflation. So far, we've seen that the corporate borrowers have been able to pass these costs on to their borrowers, but still it's a stress. And there are some sectors where companies don't have as much pricing power. Number three is the maturity wall. This is something that we're always concerned about, but especially now in this unfriendly refinancing environment, right? Lucky for us, our underlying leveraged loan portfolio that are maturing in 2024 is only about 2%, but then 12% of our underlying leveraged loans are maturing in 2025. So given all of these pressures on the leveraged loans, our corporate analysts are assigning a base case expected default rate for these loans at 4.5%. I want to throw a few numbers out just to put this 4.5% into perspective. The 12-month year-to-date default rate for European leveraged loans is 1.6%. Already you can see that's a bit of a jump. The last time we saw default rates at around 4% was during the pandemic. And just one last number to give you some perspective on this number is that during the global financial crisis, leveraged loan default rates were above 10%.
So given these elevated default rates or the expectation of elevated default rates, why do we still think that CLO notes will have their rating stables, will perform very well?
Good question. To be honest, at the end of last year when our corporate analysts were increasing the expected default rates for leveraged loans, we were also concerned, right? So we decided to do some stress tests. And we did one stress test. We called it the corporate stagflation scenario because it was loosely based on what our corporate analysts were doing, where we downgraded 30% of our assets and assigned a 5% default rate. And we ran our 300 or so transactions through that stress. And we saw that for transactions that are still in their reinvestment period, only one note was downgraded. And for transactions that were out of the reinvestment period, 13 notes were downgraded. So that gave us some comfort. A real world example is also what happened during the pandemic. So I told you before, default rates during the pandemic was around 4%, similar to our base case expectations right now. And during the pandemic, we only downgraded 34 notes, mainly from BB to BB minus.
And I believe this resilience is based in our methodology, right? Because we apply the stressed portfolio methodology. Maybe you can explain it a bit more?
I actually love talking about this because I've covered other asset classes in my career here at Fitch. And, what makes CLO transactions so particular is that these are revolving transactions, right? And I know there's like a sprinkling of revolving transactions in RMBS. ABS has some types of transactions that are revolving by nature as well, but I still think it's quite unique. And, so CLO transactions allow the managers to reinvest principal proceeds into new assets. And because they can do that, we rate to or upgrade to a stress portfolio. So let's say the current portfolio has like a 4 or 5 year weighted average life, but the covenants allow the manager to reinvest to a longer wall. So let's say 7 or 8 years, then we will assume that longer wall, essentially extending the risk horizon of that transaction. Similarly, you might have no CCC assets currently, but we will assume 7.5% CCCs because generally that's what our transactions allow for. But really, this difference between the stress portfolio and the current portfolio, that is what's providing an additional cushion for the CLO transactions currently, which are not using up that flexibility.
And is this cushion the same across the capital structure, or are certain notes more protected than others?
So, yes, they are generally the same across the capital structure, AAA down to single B. The default cushion on average for all of the notes are 10% or higher. But there is some differences. For example, the B minus tranche, there is a bigger spread in the cushions. So there are more notes that have smaller cushions than for the other notes.
Okay. And you mentioned before that the reinvesting nature of the CLOs make them more protected because we wait to the stressed portfolio. But what happens if transactions leave that reinvestment period and basically become static? Are we then less protected?
So you remember at the very beginning, I was telling you that there are some pockets of risk in our portfolios. So one of the things that we're looking at quite closely, because, actually like a third of our portfolio are out of the reinvestment period now. And that's partly because there haven't been as many refis and resets over the last year. So we did a study recently and we noticed that transactions that are quite a number of years out of the reinvestment period have higher CCC buckets, have more assets with near-term maturities, and smaller BBB and below cushions. So we are quite cautious with those transactions. I can tell you as a rating analyst that I've been to all kinds of committees in the CLO space, but the transactions that are out of the reinvestment period with these riskier attributes take up multiples of our time than the transactions that are still reinvesting. So we are very careful, and we're especially careful when we upgrade these transactions. We do have leeway in our criteria to be cautious in that way.
Yeah, no, I understand. And apart from these modeling specifics that create cushion or no cushion, are there any other risk factors, like in the documentation that constantly evolves, for example, that you are concerned about or that you're looking into more these days?
Yeah, so one of the things that we're watching very carefully and with great interest is what's happening across the pond in the U.S. There are these transactions called asset prime and up-tier priming transactions, where distressed borrowers in need of a cash injection will try to make that loan and then the new money that they are looking for more attractive by either For the senior secured lenders that decide to give that new money, rolling them into a higher lien than the other senior secured lenders, or even to take the collateral out from under the senior secured loan and putting it into a separate entity and issuing new loans out of that. Now,
this could have recovery implications.
Clearly. We have seen that the senior secured lenders that don't participate ultimately have the lowest recoveries, end up holding the bag and an empty bag. And we are very, very concerned about this. And so far, we haven't seen these types of transactions prevail here as they have in the U.S., but it's something that we're all watching with great interest, like I said before.
Thanks, Kay, for your insights. And thank you for joining us. For more information on European CLOs, please visit us at fitchratings.com. And if you have any questions on the topics we discussed, please send an email to the address on the screen.